we've seen the two main ideas that the general public have about the way banks work. Both of them are wrong. That's not too surprising. After all, unlike the Our Money team, most people don't spend their time obsessing about how banks work. And banking is complex, which means that most people give up on trying to understand it. But what about people who have studied economics or finance in school? Most of these people have a somewhat better understanding of banking. They are taught something called the money multiplier model. To its credit, the money multiplier story actually says that banks do play a role in money creation. However, this model, often presented in textbooks, is not only fundamentally inaccurate, it omits key details with dramatically significant implications. In our view, it would not be an overstatement to say that these implications turn our understanding of bank money creation completely on its head. Importantly, the money multiplier model does not emphasize the importance of the bank's access to the public's full faith and credit in ensuring that the deposits the banks create through their lending are as good as cash, something we'll go into in more detail later. Instead, it creates the impression that banking is a private affair between banks, depositors, and borrowers, with banks merely acting as intermediaries, though clever ones. Here's how the story goes. A man walks into a bank and deposits his salary of $1,000 in cash. Now, the bank knows that on average, the customer won't need his entire $1,000 returned all at once. He's probably going to spend a little bit of his salary each day over the course of the month. So the bank assumes that much of the money deposited is idle or spare and won't be needed on any particular day. It keeps back a small reserve of, say, 10% of the money deposited with it, in this case $100, and lends out the other $900 to somebody who needs a loan. So the borrower takes this $900 and spends it at a local car dealer. The local car dealer doesn't want to keep that much cash in its office, so it takes the money back to another bank. Now the bank again realizes that it can use most of the money to make another loan. It keeps back 10%, $90, and lends out the other $810 to make another loan. This process of relending continues with the same money being lent over and over again, but with 10% of the money being kept in reserve each time. Note that each of the customers who paid money into the bank still expect the bank to be able to pay them the full amount of their deposit back whenever they want to withdraw it. After all, the numbers on their bank statement show that the bank owes them back the full amount of their deposit, even though there is still only $1,000 of cash flowing throughout the economy. The sum total of everyone's bank account balances has been increasing, and so has the total amount of debt. Supposedly, this process continues until after around 200 cycles. Almost all of the original money is now held in reserve, and only a fraction of a penny is being relent. By now, the sum total of all bank accounts adds up to about $10,000. So the multiplier model that is still taught in most universities implies that this repeated process of a bank taking money from a customer, putting a little bit in reserve, and then lending out the rest can create money, because the same money is double counted every time it is relent. The model says that if the reserve ratio, that's the percentage of customers' money that the banks have to keep in reserve, is 10%, then the total amount of money will grow to roughly 10 times the amount of cash in the economy. You can imagine this model as a pyramid. The cash is the base of the pyramid, and then, depending on the reserve ratio, the banks multiply up the total amount of money by relending it over and over again. However, the fact is, what we've just shown you is fundamentally wrong and does not at all correspond to what actually takes place on banks' balance sheets, as we'll see later. But despite that, this model is still used most of the time when people talk about how money is created, whether in universities or in videos on the internet. Before we began researching exactly how the system works, we used to think it worked like this too. Balance sheet operations aside, this pyramid model is inaccurate in 3 fundamental ways. First, The model implies that banks have to wait until someone deposits money with them before they can make a loan. This would mean that banks just react passively to what customers do, that they wait for people with savings to come along before they start lending. This is not how it really works, as we'll see later. But the idea that banks have to take deposits before they can lend is key in preserving the idea that banking is essentially a private affair in which banks merely act as intermediaries between depositors and borrowers. Second, it implies that the central bank has solid control over the amount of cash and reserves it creates, which also is far from true. Nonetheless, the persistence of this idea helps maintain the vague impression that really only the government can create money, while banks are mere intermediaries, even if their process of lending extends the money supply beyond the amount the government creates. And third, it implies that the central bank ultimately has control over the total amount of money in the economy. According to this model, they can control the amount of money by changing either the reserve ratio, that's the percentage of customers' money that the banks have to keep in reserve, or the amount of base money, the cash at the bottom of the pyramid. For example, if the Federal Reserve sets a legal reserve ratio, and this reserve ratio is 10%, then in theory, the total money supply can grow to only 10 times the amount of cash in the economy. If the Federal Reserve increases the reserve ratio to 20%, then the money supply can grow only to 5 times the amount of cash in the economy. If the reserve ratio were dropped to 5%, then the money supply would grow to 20 times the amount of cash in the economy. Alternately, the Federal Reserve could change how much cash there is in the system to begin with. If it printed another $1,000 and put that into the economy, and the reserve ratio is still 10%, then the model says that the money supply will increase by a total of $10,000 after the banks have gone through the process of repeatedly re-lending that money. This process is described as altering the amount of base money in the economy. So, the most significant technical inaccuracy of this model is that if it were true, the Federal Reserve would have much better control over how much money there is in the economy than they really do. There's just one small problem. Almost everything about this model of banking is wrong. And these inaccuracies give a dramatically distorted picture of the nature of bank money creation in our economy. Here's the bottom line when it comes to the technical inaccuracies of the money multiplier. Number 1. Bank lending is not limited by the amount of reserves a bank holds. Instead, banks make loans by creating deposits first, and then they obtain reserves later. Number 2. The Federal Reserve doesn't have any real control over the amount of cash or reserves it creates, which we'll talk about later. Number 3. The Federal Reserve certainly doesn't have control over the total amount of money in the economy. Instead, banks can create virtually as much money as they like, as long as they can find a borrower to lend to. These realities of the banking system help to definitively clarify that the true role of banks is not intermediation, but outright money creation by allocating the public's full faith and credit. This becomes particularly clear when we consider that in addition to these points, the money banks create is as good as cash due to the public support. While the multiplier model acknowledges that banks do not hold the full amount owed to depositors in reserves, this liberty that the banks take, which is often compared to a magician's sleight of hand, is excused and even lauded as part of the ingenious alchemy of banking, which enables banks to take a relatively small volume of deposits and turn it into a much larger volume of loans. This financial alchemy is still generally considered by mainstream economists to be indispensable to our ability to facilitate economic activity on the scale that we are used to. We are left to think that we owe our very prosperity to the cleverness of the bankers and the system they have devised to allow them to create money, thereby enabling the development and growth of our economy. Any suggestion that the banks should have to keep the full amount deposited with them in reserves, or that they shouldn't be able to create money, is derided as a naive recipe for economic collapse, as these are thought to be constraints that would handcuff the bank's ability to keep the economy going at its full potential. Public supports like deposit insurance and lender of last resort, which we'll discuss later, are thought to merely ensure the smooth functioning of this ingenious system, which we rely on to allow our maximum prosperity. The problem is that this understanding only makes any sense in the context of the gold standard, which has not been in place since 1971, when President Nixon closed the gold window and suspended the convertibility of the US dollar into gold. If our monetary base is no longer gold reserves, but central bank reserves, which can be created as necessary, then the quantity of reserves is no longer limited in a way where we need the banks to cleverly extend the amount of economic activity that can be facilitated by a limited reserve base. If the government can create as much money as necessary itself, then there is no longer anything special about the bank's ability to create money that would justify our excusing their sleight of hand. In fact, if the government can create as much money as necessary, and it is our public support that ensures that the bank's deposit liabilities are as good as cash, in spite of not being fully backed by cash, then the notion itself of banking as a private affair crumbles. It is no longer we, the public, that rely on the bank's clever alchemy, but the banks that rely on access to our public support. The banks are revealed to be mere franchises of the government that privately profit from distributing our public full faith and credit. So it turns out that the subtle differences in academic accounts of how bank money creation works that we described earlier actually make all the difference in how we understand the role of banks in our economy, as well as the power dynamic between the banks and the public. If bank money creation is no longer private financial alchemy, but the distribution of the public's full faith and credit, then we, the public, are long overdue to assert our say over how banks allocate what are essentially public funds. It is time for the bank's distribution of our full faith and credit to take place on our terms, not the bank's. It's not just economics graduates who have the wrong information. Most mainstream economists, politicians, and other policymakers still believe money creation works according to the textbook. Yet the Federal Reserve's own documents have discredited the multiplier model. Our money is campaigning to change the way money is created, and we need you to get involved. Share this video, join our campaign at ourmoneyus.org/signup to stay informed of our campaign efforts, and follow us on Facebook, Instagram, and Twitter at OurMoneyUS.